Good day, investors. In this video, we're taking a closer look at Duke Energy, ticker symbol DUK. Duke Energy just delivered a solid quarter, but this is not just another utility stock anymore, because behind the scenes, there is a major shift happening, and it's being driven by something very simple. AI needs power, data centers need power, and Duke Energy is right in the middle of it. So in this video, we'll break down the latest earnings results, then look at the key growth drivers and fundamentals. Then we'll touch on valuation. And finally, I'll give you my personal take on why I think Duke Energy could be a very interesting opportunity right now. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe for more upcoming investing videos. Thank you very much. Now, before we get into the numbers, let's quickly understand what Duke Energy actually does. Duke Energy is one of the largest regulated utilities in the United States. As you can see on this slide, the company serves customers across the Carolinas, Florida, and parts of the Midwest. And its core business is very simple. It generates electricity, delivers it through transmission and distribution, and provides power to millions of customers. But the key thing here is the business model. This is a regulated utility, which means Duke invests heavily into infrastructure, and regulators allow the company to earn a return on that investment over time. That's what makes the business very stable and predictable. And as shown on this slide, the company is investing over $100 billion into its grid and energy systems through 2030. And as demand for electricity grows from AI and data centers, this investment becomes even more important, because it allows Duke to expand capacity, support that demand, and continue growing earnings over time. Now let's take a look at their recent results. Duke Energy reported $1.97 in reported EPS and $1.93 in adjusted EPS. That's solid, steady growth year over year. Now looking at what drove the quarter, the electric utilities segment was the main contributor. Earnings increased by about $128 million. Driven by rate increases, customer growth, and favorable weather, which added roughly 4 cents to earnings per share. At the same time, costs were higher, including operating expenses and depreciation. So this wasn't a breakout quarter, but it was exactly what you want to see: stable, predictable, and moving in the right direction. Now, the more important part is not just the quarter itself, but what management is guiding going forward. Now, this is where things start to get really interesting, because the biggest story here is not the quarter itself, it's demand. Duke Energy now has around 7.6 gigawatts of data center contracts signed, and that number has been growing rapidly. Just to put that into perspective, that is a massive amount of electricity demand. And as you can see on this slide, these are not small customers. We're talking about companies like Microsoft, Amazon, and major industrial players. Now, what this is driving is a clear acceleration in load growth, from around 1.5 to 2% to closer to 3 to 4% over time. And that's a big shift, because utilities typically grow very slowly. But this shows a real step change in demand. So the key takeaway is simple: AI, data centers, and electrification are driving a new wave of electricity demand. And Duke Energy is positioning itself right in the middle of it. And going a step further, Duke now has a pipeline of around 15.4 gigawatts of high-confidence demand, with about 7.6 gigawatts already signed and roughly 5 gigawatts already under construction. So this is not just future potential. This is real projects already being built. And as you can see here, these are large-scale developments, supporting major customers like Amazon and Microsoft. So the takeaway is simple: the demand we talked about earlier is already translating into real infrastructure and real growth for the business. And furthermore, Duke Energy also has a very solid dividend, currently yielding around 3.3%. And importantly, the company has a long track record of consistent dividend payments, backed by stable, regulated cash flows. On top of that, management is guiding for 5 to 7% earnings growth, which supports continued dividend growth over time. So when you combine income and growth, you're looking at a very attractive total return profile. So after looking at the earnings and growth drivers for the company, let's now take a look at the valuation. According to stock analysis data, analysts currently have a consensus buy rating on the stock, with an average price target of around $137, which implies roughly 7% upside from current levels, with targets ranging from about $126 on the low end to around $143 on the high end, indicating potential upside of roughly 11% on the high side. So overall, expectations are for steady, moderate upside rather than a big breakout move. And when we look at the stock performance, we can get a better view of the current setup. As you can see here, the stock is currently trading around $128 per share, giving it a market cap of roughly $100 billion. The stock has a PE ratio of around 20 and a forward PE of about 19. The company also pays a dividend of about $4.26 per share, giving it a dividend yield of just over 3.3%, which makes Duke Energy a solid choice for dividend-focused investors. So when we bring everything together, Duke Energy delivered a strong start to 2026. Earnings per share increased year over year, and the outlook going forward remains solid. But the bigger story here is load growth. Duke has now signed around 7.6 gigawatts of data center agreements, with about two-thirds already under construction, and an additional 15.4 gigawatts in the late-stage pipeline, which gives the company a very clear growth runway, tied to AI, data centers, and advanced manufacturing. At the same time, Duke is executing on a massive $103 billion capital plan, supported by over $5 billion from asset sales and investments, while still focusing on keeping customer rates affordable. So in simple terms, Duke Energy is not a high-growth stock, but it is evolving into a stronger regulated utility growth story, backed by infrastructure investment, data center demand, a reliable dividend, and steady long-term earnings growth. So in my opinion, I think Duke Energy is well positioned to benefit from rising data center demand and offers a very attractive mix of stability and steady growth for long-term investors even at current levels. And when you add a dividend yield of over 3%, this becomes a very compelling total return opportunity, especially for investors focused on income and long-term stability. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.